Okay, good morning, everyone who's dialed in. It's a bit of a different in the boardroom with Laurium today. We're actually in a boardroom, but we've just kind of repurposed it today for a little bit more of a, I guess, informal conversation between various of the team members. I think those who have dialed in before know that the idea behind these in the boardroom conversations is to get our clients and prospective clients a bit more familiar with the team and the process that we go through in selecting investments at Laurium. So this is a webinar about the 15 years that Laurium has been in operation. And actually, it just so happens that I think this is our 15th webinar that we're doing. We did a lot during COVID. We slowed down a bit after COVID. And we just thought we'd start again and bring people into our boardroom. So I'm joined today by, I think most people will know, Melanie Stockert, who's on our fixed income side, Murray Winkler, who's a portfolio manager and co-founder of Laurium. We'll spend a lot of time talking to Murray about some of his experiences, and Junaid Bray, who's one of our equity portfolio managers. And I think most people know I'm Brian Thomas. I look after the multi-asset side of things here. So I thought that we just talk a little bit about Laurium and what the team looks like. We've been going for 15 years and have built what we think is a very strong team of investment professionals that are the custodians of your assets. We've arranged the team into an investment team and then operational and business development team. For this particular presentation, I'm going to just run you through the people that are involved in the various strategies. We started in the hedge fund space roughly 15 years ago. And the three people involved as the portfolio managers of the hedge fund strategies are highlighted in blue: Murray, Gavin, and Matthew. Then if we look at the SA equity strategy, I already mentioned Junaid is one of our co-portfolio managers in SA equity. We're going to be talking to Junaid a little bit later about his role as a multi-counselor equity portfolio manager. And then obviously Murray, Gavin as the founders of the business. And Dwayne Dippenaar is also one of our SA equity multi-counselor portfolio managers. On the multi-asset side of things, we've got a wealth of experience. We were just saying that this room seems quite balanced in that we've got people with hair in the middle and Junaid and I with no hair on the outside. But I sit on the multi-asset process with Murray, Gavin, Rob, and Melanie. Sadly, Rob can't join us today. We'd initially hoped he was going to be able to join us. He's on a plane to the US as we speak. And then on the fixed income side of things, Melanie takes charge of the South African fixed income space for us. And Paul Robinson is very involved in the African fixed income space, where we have a decently sized African bond fund. And then finally, our African strategy. Gavin Paul look after the African equity strategy that we've been running for a number of years now, and then Mel and Paul look after the fixed income component of the African strategy. And I think it's important to note that I've kept up all the other analysts on the slide throughout this journey, in that it's not just the portfolio managers that are involved in the particular product. It is the entire team that generates the alpha over time. The final one to point out is Rob, who I said is sitting on a plane as we speak, about to land in the US, where he's meeting with a number of companies over the next few days, who is the latest addition to our set of funds. And I'm going to run through the funds and the performance of funds over the 15 years that we've been in operation before we get into sharing some of the experiences. And Rob spearheads our global strategy. We've now got what we believe a complete full set of funds that will enable any investor looking at Laurium the ability to invest in a fund wherever they would like to be on the risk spectrum, starting from the aggressive long-short hedge fund right down to the Laurium BCI Strategic Income Fund, which Mel runs, from highest risk, potentially highest return, to lowest risk. And you can also think of it from a life staging perspective, where you would like to put your clients. What we've been able to achieve at Laurium, I think, is actually quite special. I'm going to run through all of the unit trusts that we have in place over the 15 years in chronological order of when we launched them, and show you quite an amazing feat that in every single one of the unit trusts that we have out there, we've been able to generate positive alpha over time, starting with the long-short hedge fund, running 3.7% alpha over 15 years. Our market neutral fund, also 3.5% alpha over 15 years, generating just on 10% return per annum for investors. Our aggressive long-short fund has been really fantastic performance, 8.7% alpha over its benchmark over 10.5 years, and Murray returning just short of 14% per annum for investors over that time.
16.
Don't
Market at 8, double the market.
Double the market.
Over 10 and bit years.
I knew you'd correct me there. So the next one was our first foray into the long-only space, the Lorem Flexible Fund. And now we start to look at the alpha that we've generated over time and also the rank relative to competitors. So 0.9% alpha over time looks decent relative to the fund's benchmark. But if you look at it relative to the blue line there, that's the competitive landscape. We've ranked very well, done very well on a relative basis to the competition up there. If we look at our Net Group Equity Fund, been running for 9.5 years. We converted the Lorem Fund into the Net Group Equity Fund. We have generated 1.2% alpha over time. Murray and I were debating it last night. He said, well, it seems quite pedestrian, but if you add 1.2% alpha every year, you're going to do reasonably well as an investor. And as a result, we rank at 9 out of the 50 funds that have been in operation since we launched this fund 9.5 years ago.
Maybe to add in, Rana, I mean, the average equity fund manager is 1% below the index as well. So 2.2% ahead of the average equity manager. Slightly better.
Slightly better. And I went back one. Let's carry on moving forward. Mel, the Lorem BCI Strategic Income Fund, which has been going for 9 years, alpha of 1.1% and a rank of 13 out of 52. I guess what it doesn't bring in is, and you can share with us the stats of how many negative months that fund has had. I think it's very limited, right?
Yes, yeah, we've had 4 negative months in our history with some very, very difficult fixed income cycles that we've navigated. So yeah, we're quite proud of that. We have that performance.
Very well navigated indeed. And then our Amplify SCI Balance Fund. This was the Lorem Balance Fund. We partnered with Amplify some 4 years ago. And we've performed pretty well in this high equity balance space, generating alpha of 3% over our benchmark, and we rank 11 out of the 124 funds since inception. Very important to note, all of the performance that I've shown you so far is net of fees. So this is after the highest fee class in each of the funds that I've mentioned. And then in doing the transaction with Tantalum, which took place roughly 3 years ago, where Mel, Rob, Mike, and Jovan joined us, we inherited the PPS Stable Growth Fund, one of our strategic partners. Good alpha since inception. It's had a very strong running the last couple of months as well, ranking 24 out of the 82 funds in that medium equity sector. And then our low equity fund, the Staple Prescient Fund, which Mel and I look after, decent alpha over time, been very stable in terms of its returns, and ranks well, 11th out of the 128 funds in that sector. Our Africa Bond Fund is primarily invested in African Euro bonds, and also has been able to generate 0.2% alpha over its benchmark in the 3.5 years that it's been in place. And then finally, as I mentioned with Rob, who's sitting on United Airways on the way to the States at the moment, having joined us, we started a global active equity fund. It's a Mauritian-based vehicle. It's been launched for roughly 2 years, but Rob had a history, and that's the grayed out bit, of investing in very similar equities beforehand. And if you look at the fullness of performance over time, 1.2% is the alpha that we've generated. If you look at it since we launched that fund, we're basically in line with the benchmark. So it's been a pretty successful 15 years, we believe, of being in operation. The idea of this webinar, though, is not to just talk about our performance. I just thought I'd introduce how we have performed and some of the success factors that we've had. The idea is more to have a conversation around some of the things that have formed Laurium over time. So I'm going to stop sharing my screen and click over into full screen mode so that you get the full picture of us, and you don't have the screen on the one side, and move into more of a question and answer session. Now, this question and answer session is open to everyone in the webinar, and as is usual, and if I don't drop it, I've got a fantastic Magnum bottle of Laurium wine to offer who we adjudged the best question coming through on the Q&A line. So you're welcome to pop your questions on the Q&A line and join in the conversation. I'll lead some questions, but pop those questions up. We know who our regular question contributors are, and I'm sure they'll do us proud. Murray, I'm going to start with you. Must have been a bit more than 15 years ago that you contemplated setting up Laurium with Gavin. Do you want to just give us the background? You know, what happened? How did Laurium come to part? And what were you going to embrace as an investment philosophy to drive Laurium when you conceptualized it? What is it? Probably 16 and a half years ago.
Yeah. So I guess a little bit of background. I guess I've been at Deutsche Bank for 12 years. Prior to that, 6 years, Ivor Jones Roy, started as analyst there, and we sold out to Deutsche Bank in deregulation in 1995. So effectively 18 years, the last 3 years as CEO of Deutsche Bank South Africa, and then in fact, my eldest kid was in matric, and decided to take a sabbatical. Thought it'd be about a year, ended up being a sabbatical of 1.5 years. So during that time, through that time, decided what I wanted to do. And I knew that I wanted to move on to the buy side. Having been in broking, investment banking, really love markets and wanted to do something on the buy side. A couple of options were put on the table, but I did think that the hedge fund was probably, there are a couple of hedge funds around. The industry was very small. It was only 30 billion at the time. I think it's the most unconstrained and probably, dare I say, intellectually, it can be a smarter way to run money. And I did think it would grow because at that stage, the US was, or globally, hedge funds were about 2.5 trillion. We were only 30 billion. So at that stage, thought, wow, this is a place that's really going to grow going forward. So that was a decision there. Then I thought, well, okay, I need to get someone to join me. Couldn't do it by myself. Couldn't do it by myself. No. I needed someone younger, a lot younger, more energy. I'll provide the wisdom. So anyway, Gavin was actually working in London, and in fact, into the research team. I ran research, sort of hired him into Deutsche many years before, and had a chat to him, and he was very keen to come back. And he did delay his return because he wanted to get about 4 months. I set everything up. He wanted to still get his last bonus at Deutsche Bank. So I didn't tell them. Still picked up his bonus. Yeah. So that was the outcome. And we started out as hedge fund and really thought that that's what we'd be, a hedge fund business. And from a fundamental, I guess we had very good training, Ivor Jones Roy, some great mentors in Ivor Jones and Ted Woods, who was CEO of Deutsche Bank before, about analysis, fundamental analysis, and very much on the financial side of things. So core, fundamental, bottom up. And that was the basis of anyone who's come through Deutsche. Brian himself has come through Deutsche, Gavin, myself, and a couple of the team members, Craig Saru, all came through that process. So fundamental, bottom up, hedge fund business is what we thought we would be.
There's some questions coming through on the chat, which I'm going to address as they come through. We might not get to all of them, but I think as they fit into the conversation, I'll raise them. When we set up Laurium, what did you think our competitive advantage was going to be?
Well, I think if you look at step one, you're analyzing companies, which is the most important, picking stocks. Then you need a portfolio construction and you need risk management. Those are the 3 buckets you need to look at. But picking stocks, step one. And if you pick a stock, I'd say that there's business assessment, financial assessment and valuation. And everyone sort of knows that, but I think it's how well you do it. And that is the key. You've got to do it better than the others. So I think pretty competitive in everything we've done. I mean, I can say that at Deutsche Bank, 11 years there, 12 years, 11 of the 12 years, Deutsche was ranked the #1 research house. So on the sell side, we were definitely pretty good, but you had to implement it. So financial analysis was a key. I think that if we look at our investment team, 90% of the people will either have a CA, CFA, so it helps in your analysis, particularly the financial analysis. We still get lots wrong, without a doubt, but if we get less wrong than the others, we have a competitive advantage. So we're one of the few firms that had investment banking backgrounds. Most people come from the buy side. We came out of sell side, so underwriting, special situations, capital raises. We knew that space very well. And we'd also done quite a bit in Africa as well. So those were additional aspects where I think we could punch above our weight relative to others.
And the relationship you and Gavin, I observe it on a daily basis, but maybe just to share with some of the listeners, the yin and yang of how you and Gavin have worked together over time. I mean, I remember way back in the day when we were in the same, I think you were running research and Gavin was an analyst. There was always a good relationship, a complementary relationship. And you fostered that, or we fostered it into the Lorium environment. Can you just share a little bit about how that works?
Yeah, I think personality-wise, our values are similar. That's a good thing. Very important, the values to start with. I think the personalities are quite different. We both work very hard, very competitive in what we do. We want to do really well. I think Gavin sort of was in research, and then he moved from research after a while into the derivative side, and did that in SA a bit, and then in London. Structured transactions. So anything special situation he gets really excited about and very detailed dive into things. He's probably, I'm the cup half full, he's cup half empty. Always worried something will go wrong.
What am I then?
We'll work that out. So I think we complement each other quite well. I've sort of researched more strategy, top-down stuff. So I think we definitely don't. So I think working together, sort of, we challenge each other at times, and I think that brings out the two of us together. It's a lot more than just having two individuals.
I'd agree. Junaid, you joined us about 4 years ago. I think it was from I guess a slightly different asset management background, a more index cognizant potentially background. How have you found it? Give us a bit of your experience in joining Lorium.
So I think, look, it's been a fantastic journey in this last 4 years. I think, look, philosophy is always aligned in the sense that, it's fundamental bottom up, and I think that's predominantly the way all of us think. So I think that's always there, valuation based, fundamental bottom up. But I think if I look at our industry, I think there's no shortage of very smart, bright people. But I think what stands out for me at Lorium is the strong emphasis on team dynamics, team culture, and a team spirit. So I think we all in the office every day, we enjoy working together in the office environment. I think, connecting to our peers who are perhaps in the Joburg office or overseas, and just bringing that all together. And then I think the diversity of the team as well. We all fundamentally adhere to the same philosophy. But if I look at the diversity of the team, from an investment banking background, Muddy, Gavin, yourself, and then if I look at some of the other members of the team, Mal, Mike, Rob, myself, strong buy-side experience over the years, and how the diversity comes together, I think it just creates a lot more robust debate. And you can see it's quite vigorous when we do debate the stock or an idea, because you're getting all this diverse views coming together to ultimately, add great alpha to clients at the end of the day. And then I think also that part of the sell-side dynamic, I think there's a strong focus on client centricity and bringing it back to delivering to the end client, and the client service element comes in quite strongly there as well. So I think that's some of the differences and some of the nuances that I think that, I experienced at Lorium coming in.
Mel, what was your experience like 3 years ago when you guys joined us?
Yeah, so I suppose the best way to illustrate that is with a story.
I feel that I can get the back to this story.
Actually, my colleague Rob and I have worked together for a long time at Coronation and then at Tantalum and then joining Lorium together. And I think he encapsulated it so well. He said in our early days, he goes, Lorium operates in a very different cadence to anywhere where we've worked before. And I'll give you an example of that. So we joined in 2020, so COVID. Tough year on so many fronts. It's now December, the 28th of December. We're preparing ourselves for the new year mentally. And I get an email from Brian with asking for all of our forecasts for our first asset allocation meeting, which is a very detailed spreadsheet where you have to come up with point forecasts for the coming year, which is fine, 28th of December, but that's fine. And then next into my calendar goes the meeting for our first asset allocation. The first working day of the year was Monday, the 4th, and we had asset allocation on the 5th, 3 hours of intense discussion. And that was welcome to Lorium. That was the introduction. And I mean, I jest about it, but it was actually fantastic. It's all of those points of contact and debate were a really good way to get us integrated into the team. But I think that cadence comment does hold true to this day. And one of our clients actually described us the other day as a speedboat in their portfolio. So they had, ocean cruises and speedboats. And I think that's actually such a good description for what I experience at Lorium. There's no dead weight in the investment process. Speedboats always try to win the race. They're always going really fast. And I think that's absolutely apt. And just one point I'd like to add, just in terms of my impressions, obviously from the outside to going to the inside, and it's something that Junaid mentioned as well, it's the team dynamics and interactions. There's such a good sense of humor amongst the investment team and the rest of the Lorium team. It actually took me by surprise. When you're having a really tough day in the markets, it's really good to have people alongside you who can pick you up and add that joke and that lightheartedness to the situation. And I think that was notable for me. That was one of my first impressions.
And what about being a fixed income sort of specialist in a house that was initially set up as an equity long short hedge fund house and then progressed into equity? How
Yes.
I know I give you a lot of hard time about bonds ripping when they go.
Yes, indeed, you do. No, it's a good question because it's an interesting dynamic. I suppose, initially, you think that the two disciplines are quite different, and I learned that very early on when we had our first asset allocation meeting that I discussed, is just how much experience there is in terms of all the different cycles that we've had. So in fixed income, macro obviously is so important, and looking back at previous cycles and how things have changed economically, globally and domestically is such a big important part of that. And if I look at our asset allocation team, we've got 5 individuals that have seen it all. I mean, we saw the Asian crisis, we saw the tech bubble, GFC, all at perhaps at different houses, QE, Nanny Gates, COVID, all of those were big events where we all learned lots of lessons individually. And when you can put that together, that's really useful for me as a fixed income manager to draw on those experiences and those skills. So that's really key. And then also, obviously at Lorium, we are building the multi-asset side of the business. And I think there's such a keen understanding and appreciation of how fixed income fits into portfolio construction in that space. So that certainly helps my task. But it does mean that I often have to put what I call my bond hat on. So talking to equity guys, we're different animals, fixed income managers. And we often have to think about things in slightly different ways. So, corporate bond, we just want the corporate to pay us back in time. We're not really thinking of the blue sky or the upside. There are different nuances at play. And there are some people, let's call one of them Brian Thomas, who comes and rips us off a fair bit. We manage portfolios together. I'll have high conviction in a view and I'll say, let's put 2% in the portfolio. And you'll say, but Mo, I don't get out of bed for 2%. Like, that's ridiculous. So certainly, there's an interesting dynamic and interesting debate that comes to play between us different animals.
Talking about interesting debates and dynamics that are at play. You're one of the multi-counselor equity portfolio managers that we have. I think we introduced it a few years ago now, maybe 2-3 years ago now.
Just over 2 years ago.
How does that process work? For those who are not familiar that are on the line with the multi-counselor, how does that process work? How do you and Dwayne work relative to Murray and Gavin with the multi-counselor? Because it's an equity building block that a lot of our portfolios are built off, and the 4 of you are are a very key component to that equity building block.
So when it comes to the equity portfolio management side of the business, as you point out, it's a very key building block for all our products. We looked at various iterations as to how if you've got 4 portfolio managers on that fund, what's the optimal solution to get an end result for the client? And we looked at various iterations, co-portfolio managers, etc. And the one that we felt was the optimal solution was the multi-counselor approach. So effectively what it means is each portfolio manager has their own slice of the portfolio, which they have full autonomy over. And so what that means is when we've got the 4 portfolio managers, look, we all adhere to the same investment philosophy and process. So about 85% of that portfolio is the same anyway. But when one of the portfolio managers wants to bring a new idea into the portfolio and you can't convince the others, it gives you the chance in your slice of the portfolio to implement that idea. So where we find differences amongst the 4 portfolio managers, 85% is similar, but it might be position sizing on some of those positions might differ slightly. And there might be 1 or 2 different ideas that a particular portfolio manager likes, and he puts it into the portfolio. Some of the other portfolio managers might monitor that and get more familiar with that idea and then also buy into it over time. But at the end of the day, we always keep the aggregate portfolio is always what we look at from a risk management perspective. And that's what the end client sees. So we're always worried about what does the aggregate portfolio look like for the clients.
Yeah, I think it's added value over time. Maria, we talked a bit about at the start about the launch of Laurium and the journey that you've been on. Are there any trades, anything that kind of stand out, either good or bad, that really marked the performance track record of Laurium over time?
Yeah, there are a lot.
Okay.
A lot of good ones and a lot of bad ones.
Give us an interesting.
Yeah, and a lot of stressful moments and a lot of great moments. But maybe I'll just highlight 2. I guess from a hedge fund point of view, because that's what we really sort of started the business as. There've probably been 3 really big drawdown periods on that. We started 6 weeks before Lehman's, pushed the button. So not very clever, Gavin and I. Went through that and the market fell by some 35%. We had about a 10% drawdown. But then we got to COVID and we had quite a bit of protection in our funds. Now, understanding that if you put spreads, collars, if you're doing puts, it's expensive. Banks make money. So protection's expensive. But when something goes wrong, it suddenly is really good. And we've always had a bit of protection in our portfolios, particularly in the hedge side, not a huge amount, but we buy when vol's quite cheap and we put some stuff on. But we rolled off just sort of literally about a month before COVID. And then we thought during COVID, we totally underestimated the effect. And we had a seriously big drawdown in that period for our hedge funds. Not as bad as the market, but still for our hedge funds, it was sure. It was a pretty tough period. And from that, we came through that. We bounced back pretty quickly because it's short and sharp and we're back up, but it's still, we had quite a decent drawdown in our hedge funds. And from the learnings on that was sort of, I guess, that on protection, in our hedge funds, we actually just need to consistently over time have more than what we had. So we paid away a little bit more, still managed to generate good returns. For instance, I mean, if we go back right now, we probably have sort of 30% in our long short of notional protection on the funds, and still managed to generate good returns with protection. So that was one thing. Just it's expensive, but particularly in hedge, you need a protection. Long onlys, we have a lot of debates. I know at times Ryan himself now we should have protection. I'm less. You get what you sign up for in some of the funds. If it's low equity, it's low equity. If it's high equity, it's high equity. So do you really want to pay away protection if you've got a long-term view? So not so sure about that, but definitely in hedge funds. And the other one, maybe in the long only space, which comes back to learnings in life, was, I mean, we're very fundamental. We do the analysis of companies, the financial analysis, but we still got caught out by Steinhoff. We had Steinhoff across all our funds, when the share collapsed. We'd had many meetings, understanding. We'd had the FDs spending drawing circles for us on a board. Gavin, myself, and Craig, Saru, went in. We spent 3 hours with him one time drawing the structures of the business on a whiteboard, and page after page, that's how it works. And you'd look at the cash flows, but they kept doing deals, and then the segmental reporting it would change. And I think that, and then they did the Pepkor deals, so Visa sold in, and then that's a very good cash generating business. Anyway, the bottom line is we didn't focus enough on the cash flows, I think, even though we do. So cash flow. And I think there's working capital moves around. People also get confused with that. So I think definitely ratcheted up our efforts on cash flow, the analysis and the cash flow. Earnings IFRS now, there's a lot of adjustments, but you just got to understand cash flow and sustainable cash flow. So I think that's one area and we can still improve. We could all get better still, even me. Which shows after many years. So I think it's just really understanding that and that detailed analysis and really understanding it. Yeah. So that was quite a smack for us as well. And look, there've been a lot of other ones, but it's normally the negative ones that
are there any positive ones that you remember?
Positive ones.
Yeah. Was it just
there a lot of capital raises over time, special situations, unbundlings. We've made a lot of money over time. When Rainet unbundled in the beginning, was formed, we made a lot of money. Around some B events where a FirstRand group coming to an end. Exara, big ones. There've been a lot where we've made on sort of special situations, which don't happen that often, but that's been pretty good, events that happen. Recently RMI was one with, again, what happened there with the unbundling. We shorted out Discovery, shorted out Momentum. So we just had the rump of our insurance, and that sort of over 6 months doubled our money on that trade. So there are lots of good ones, but it's the bad ones that you need to focus on. And so you keep learning, and I guess the one thing, it doesn't matter, they always learn and always think, geez, how did I get that wrong? What did I miss? So if we can get 65% of the time, we can be right over time. We're going to be in the top decile of performance. And so I think that's what one's trying to strive for.
There's a question that's come through from a guy who actually used to be a client of ours when we were at back in the Deutsche Bank days, Mark, who's asking around, how, as we've grown, have we been able to hold on to the culture and the DNA of the business? It's a very good question. Junaid, you might have, having come in at a later point and been sort of inducted into the DNA and the culture, how do you see us maintaining it?
So I think, look, I think it's a very important question, and I touched on that a little bit earlier. It's about the culture, because clearly when we see CVs, there's lots of guys, CAs, CFAs, very bright individuals. But when we bring on individuals onto the team, I think we place a strong emphasis again on that fit into the culture and the way we think. Because I think a lot of us here, we really it's more than just a job. We thoroughly enjoy investments. We come in every day and we just enjoy markets. We enjoy the chance to make money for our clients. So it's bringing in individuals who fit into that culture. And even with when we brought when Tantalum, the previous Tantalum team joined our team, there was a strong emphasis on fit, and it's worked very well. We'd all met. We'd met Mal. We knew Rob and Mike from the markets, and interacting with them as well to make sure that the deal will be a good deal in terms of cultural fit. So I think to maintain that the edge that we have, I think we place an emphasis on culture and maintaining that culture, as well as bringing in with the interns coming in through the business and the mid-tier analysts coming up as well, all buying into the culture of the firm.
There's another question on the line. I don't know if the participants can see all the questions, but just one that's come through from Ted, who actually used to be both Murray and my boss back in the Deutsche Bank days, asking how we balance the desk-based analysis that we do against the noise that comes through from the market. How do we filter that noise? Murray, what technique do you use to filter the noise?
Geez, Ted should be answering the question himself. He knows. So I'm worried.
What, did you create more?
No, but I get it wrong.
Look, I think nowadays, I think there's lots of noise in the market. I think we're bombarded with more data than any other time than before. And I think, look, it's an interpretation of the data that's important, and then filtering out that noise. So I think just always stepping back and thinking of the bigger picture. Does it really make sense? You know, not relying too much on management guidance, because they often don't know. They're stuck in a short cycle where things are either cyclically depressed or cyclically booming. And we all tend to extrapolate that into the future. So it's stripping out that and actually looking at the bigger picture, like what does this really look like, and corroborating that with what other companies are saying, what suppliers are saying, customers are saying, competitors are saying. So I think that's the way that we use to filter some of the noise.
Yeah, I guess maybe just thinking of that question, and again, if you summarize what a market's about, and I think the old adage actually goes, Benjamin Graham goes back to him, and then Buffett went and talked about it. And I think if you look at many sort of 35 years in markets, to me, what is it about? And what they said is in the long term, the market is a weighing machine. It weighs the earnings. Okay, now that's not correct, but that's what it's actually, it weighs the cash flows over time, in my view. So that was early days. It's the cash, not the earnings, but that's, so it's a weighing machine. So long run fundamentals, intrinsic cash generation over time is what generates how shares perform. But in the short term, it's a voting machine. So basically sentiment take the market up and down. So you have an analyst who thinks fair value is 100. 3 weeks later, 3 months later, it could be sitting half price or twice as expensive. So it's sentiment drives markets massively, and that's when the inefficiencies. So I think linked to the question there is that we do our fundamental analysis. This is intrinsic through the cycle. This is my value. And we've been caught out once or twice by doing that. You've got to look at, you've got to be talking to people, you've got to understand what the market thinks at that point in time. And you've got to look at technicals, flows, the selling, the buying. What are the internationals thinking? Who sets the price of a share? The internationals are offshore. If you're looking at Richemont, you're looking at Billiton. We don't set the price. What do internationals think? So it's understanding that. So I think the comment there knows for markets. Some people have got it and 90% don't, I think. It's your feel for markets, it's nuances. So the technicals are quite important. I know some people don't believe in technicals. Fundamentals core, but understand the technicals, flows, price actions. That you put all of that together and you're going to be able to be, I believe, slightly better by doing that.
Can I add to that? Sorry, just on the fixed income side. So someone made a comment last week that really struck me and made me realize how important it is for fixed income managers, but also just portfolio managers in general, to have experience of the cycles. I mean, there's no easy way to learn that. You have to live it to learn it. And it was actually one of the Fed presidents that was on a panel that I listened to last week. And he made the point, talking about the US banking crisis, just how many banking individuals in the US right now have got no experience of a rising interest rate cycle or interest rates at these levels. And I mean, that really struck me because that's right. I mean, we've had such a long period of a very different type of market to how we grew up. But you have to have learned those lessons in the past to have the perspective. And I think that does filter some of the noise out. When you can lift your head and just think about what has happened in the past, how that played out. Of course, there are going to be differences every cycle. But I think the fact that we have so many individuals that have lived through that is really, really helpful in that process.
That's great insight there, Mel. There've been, on the equity side of things, maybe both Junaid and Murray can chip in here, there've been a couple of similar questions that have come through around the declining breadth or the narrowness of the South African market and our ability within a smaller South African market with the number of delistings that we've seen over the years, our ability to add alpha in the pure SA equity space. Thoughts around that?
So I think if we look at the SA equity market to start out with, I think most of your alpha really comes from getting your big bulls right to start out with. So you're either from a stock selection perspective or sector allocation perspective, most of your alpha is going to come from that. Yes, you can tweak that and add some extra alpha by, delving a bit into the less liquid space, but then you really need to have a very high conviction and a much larger margin of safety. That's on that angle. Then what we've also done, I think, over time is, I think, some of the early slides that Brian had put up, when we looked at the global strategy, Rob is the key portfolio manager on our active global portfolios, but supported and complemented by the rest of the team. So each of the analysts, we're all delving into, when we're researching ideas, we're looking at some of the global ideas as well. And we need to do that anyway for some of our dual listed companies locally, Richemont, the miners, some of the beverage companies, etc. But so I think there's been learnings both sides as well, because some of the dynamics at play in the SA economy, we've learned that some of the similar dynamics are at play in Europe, in the US, and China, for example. And it's been a great addition in terms of learnings to what we and the underpinnings and the fundamentals of the SA shares that we look at. So complementing that with the ability to, and we have portfolios where clients have asked us to start selecting some offshore stocks within those portfolios to complement alpha and supplement alpha, and we are doing that already.
Yeah, and there was actually an earlier question about multi-asset, which I'll take, and how we integrate the global process into multi-asset. Across most of our multi-asset funds, we've traditionally run a kind of a smart beta strategy within the multi-asset class funds. With Rob, Mel, and I guess Rob in particular joining us and growing that individual stock picking capability within the business, what we've started to do increasingly is add the individual stock positions through the Laurium Global Active Equity Fund into our multi-asset class space over time. So it's becoming a more and more integrated process at Laurium, where our ranking tables are more integrated with local and international international stocks. There's a I think
should I add to that? I mean, what Janay said there is that our market is, I mean, there's only 35% is pure domestic SA, then some minors. So more than 50% is global. And if you're doing, we have the stocks, the Richemonts, the British American Tobacco, the AB InBevs, I mean, all global stocks. And we have analyzed, the teams analyzed that, because you don't just look at SA, you look at global. So, I mean, and interesting enough, I was just thinking now that in probably late 90s, in fact, when Gavin and I at Deutsche, we both went over the luxury conference in Paris. Obviously, it's quite nice to go to Paris. And that was a 2-day conference, and Rob was there as well. So he was there as well. So the three of us, we all did, actually at the time, we're doing Richemont. So that's why we went so luxury. We also, the three of us ended up being also in probably the late 90s, a CAGNY conference, which was the global US conference in Florida. It was a nice trip. So we actually hosted Rob. We went fishing on a boat. Deutsche had some money to spend, so we took a couple of flights fishing at that stage. And Rob was on the boat, and we had 4 clients. So we're doing global stocks, tobacco, going around plants, seeing the luxury plants as well, Switzerland, Mont Blanc. So a lot of that, you've covered those stocks. So Rob's picking all the stocks, and the analyst below, if it's going on the tech side, Junaid looking at sort of at the tobacco side. It's an integrated process. So we're just doing more and more of that and broadening out.
There's I think, an important question coming through from Guy around owner asset managers. If we're able to hold on to the culture, philosophy, process, that we should be able to generate excess alpha over time. But how do we safeguard the succession of the business through succession planning? I'll start to answer that, and Murray, Junaid, Mel, please free to chip in. But one of the reasons that I started with the various team slides that I did is, if you look at the construct, and it's a very deliberately put together construct of the asset management team that we have at Laurium, there are various people that are responsible for various products, with a huge amount of backup that exists in each of those. You can call them areas, whether it's the equity area, the multi-asset area, fixed income, etc. instead of having a philosophy where there's a one or two key man dependent people, I mean, Murray and Gavin are obviously still key to the business, but we've been very deliberate as leaders of the business to try and ensure that that culture is passed through the organization, and that there are people in place at each of the particular products that we have to take over and carry that culture forward and carry the alpha generating potential forward. So I think it's a very good question, Guy. Murray, I don't know if you want to add any more to it.
Yeah, I think you've answered it right. I mean, we purposely put in place building succession, if we look on the hedge fund side, Matt's been with us almost 10 years now. So he's come in with the hedge side. We moved to the multi-council. So Dwayne and Junaid coming in on that front. So Gavin and I still run our slice together, and then sort of two other slices. And then building out different areas. I mean, the fixed income, Mel runs all of that. And she's got Shwebi behind, who's sort of will come through there. Paul Robinson in Africa sort of heads that side up. And I think that we've Rob doing global. So we building succession in the team. There's lots of experience in the team. So it should be a seamless process when people disappear.
Mel, I actually got an email earlier today from someone who's trying to get into asset management, a lady who's trying to get into asset management. It's still an industry that's very male dominated. You've made a remarkable success of it. What advice should I offer the person who's just sent through an email?
Oh, that's a difficult question. It is a very, for years and years of development, it is still very male dominated. I mean, let's just call it what it is. But I think my advice, having worked at different teams over the years, my one piece of advice would be don't change yourself. So as a woman, you've got a very important role to play in an investment team, and don't try to change the way that you approach the world or that you put a different mantle on when you walk into work every day. You must stay true to who you are. And a lot of that comes with confidence. So I think that women, when I think about the skills that women have, and I'm generalizing horribly here, but generally women have a lot of very good soft skills, right? So when you're younger, I think it's so much easier for us to use those soft skills to sit across from someone and say, I actually have no idea how that works. Could you take me through that, from the basics up, which I think, women are generally a little bit better at approaching things like that. And I think use those skills to build your knowledge base and use the people around you. And at the same time, those soft skills are really good at building up networks. So there's so many female investment professionals in what is a very small market still. So use that network within your company and within the industry. I mean, I certainly rely on a lot of the peers that I have, the female friends, that might just be approaching an issue and you just want to bounce it off someone and say, how would they have responded to that? Or are you overreacting? Whatever, use your softer skills to do that. And I think importantly, pay it forward. So if you do have success in the industry, bring more women into the investment team. I think, Junaid was talking about diversity. Diversity is so important in making better investment decisions. And thinking through everything I've just said, I really do appreciate how Lorien welcomed me. So you guys know me, you know who I am, and you don't try to change me, which I think is remarkable. So that's fantastic. And also when I was growing the fixed income team, when I brought Shwebi on board, obviously everybody met her, but I remember, Mary, you in particular, you said to me, Mel, this is someone you're going to be working with every day, completely back you, go for it, very happy. And she's been such a great addition to the team, and I think just brings an energy to the team, which is really useful. I think all of those factors are really important in thinking about advice. And let me help you. Send the email to me, and I'll give them some advice.
We'll certainly do so. I think we're kind of running towards the end of the time that we have here. There's one question which Barent has asked around implementing AI as part of our investment decision-making process. Junaid, I don't know if you want to take it, or if you want me to.
It's above my pay grade.
Look, it's something that we haven't embraced yet in the ChatGPT form of AI, I guess, if you look at it that way. But some of the tools that we use, I mean, one of the tools that is kind of ubiquitous within Lorium, costs us a fortune to keep it running, is Bloomberg. And Bloomberg, most people will use it basically just to see the prices of where shares are traded. No, not looking at anyone in particular here, Murray. But within the Bloomberg functionality, it was probably one of the I guess, leading avant-garde AI tools within the industry. If you know how to work Bloomberg well, there's a huge amount that you can generate out of AI. Junaid and I have often had debates as to whether we should hire another analyst. And I think Junaid often says to me, I'd rather have another Bloomberg terminal than another analyst, because it is just such a powerful tool if you use it well. I don't want to
Bloomberg terminals are expensive.
especially if you just look at the prices.
And charts.
And some charts. I don't know if there's any sort of closing comments that anyone would like to make before we elect who is the either the most prolific or the best questions. Murray, you normally are the adjudicator of the best question. But any sort of remarks just to end?
No, I think, just to conclude with what we've been saying here this morning, I think we genuinely feel that our edge is the team dynamics and the culture that we all have, and the passion for investments and making money for our clients.
Murray?
Yeah, I think the challenge is obviously you're only as good as your next innings. I mean, we had a great rugby game against New Zealand. We've got the World Cup coming up. That's what counts. So history, we're very pleased on how we've performed historically. Hopefully our returns can be as good or better going forward. So I think excitement is trying to look after our clients' money and to generate alpha and try to beat our benchmarks going forward. Continue doing that is the most important thing.
Mel, any final thoughts?
Just to follow up on that, I mean, there's no room for complacency, and I think we all understand that so deeply. Every single day, the scoreboard starts again, but you have to do it with a team that can help you be better than the individual, and I think that's something that we have here. For sure.
Yeah, I think I'd echo what everyone said. We're 15 years in. We've only just started, and we just hope that those charts that I showed you with positive alpha. When we do this in 30 years' time, to answer Byron's question around succession, probably maybe all of us won't be here in the next 15 years, but the next lot will.
Well, I won't.
You will.
You'll still be here, I'm sure, Murray. This is a hobby for you, not a job. I think we'll hope to continue to be putting runs on the board. Murray, unless you've got an executive decision you want to make around the best question, I quite like Lizette, who's come through with a number of questions today. Her last one, and I don't know if people can see it, so I'm just going to read it out. She says, I miss coffee and a rusk. Will there be any meetings in future where we can network with you? Is it not boring that you cannot see the audience, but we look at you? And the answer, coming back to our culture, is absolutely. We far prefer the personal interaction. We've always been in the office, even as soon as COVID allowed us to come back into the office. We've been in the office. We welcome clients into our office at any point in time. We welcome clients to join virtually into our morning meeting. We've done a couple of things this year, which we've called our under the hood presentations, and we will do more of them going forward, where we give you the opportunity to come into our office, interface with us, have a coffee, have a rusk, even a glass of wine. So absolutely, Lizette, thank you for all of your questions. And I think on that note, we will get in contact with you, Lizette, and send over the nice bottle of Lorium Red. So enjoy it. Thank you to all the people who've joined us. And with that, I think we'll say goodbye.